Hey guys, what's going on? Broke Investor here. Making a new video, a new beginner's video. Today's video will talk about options trading for beginners. I'm making this video because there's a lot of people out there that, they either feel like they want to get involved with options or they are involved with options and they feel like it's too complicated, or then there's the people that don't even bother with options. Hopefully those people, click the video too. But regardless, options trading honestly is not as complicated as it sounds. Now, when you see or read like a little bit here and there, the language it is kind of overbearing. So hopefully I can explain this in simple terms, as best as I can. And hopefully, when you guys have finished with this video, you learned something. So anyway, let's get started. So when you think of options, now, let me just start off with also, if you have a brokerage already, you're already investing, the default will not include the options level. You'd actually have to apply within your brokerage to a certain level that would allow, a certain level of options. Level 2 is the basic level for options. That's typically where you'd want to start off. So you can apply within your brokerage, tell them I've invested for this many years. I forget what they ask, but for the most part, they should approve you. When I applied for Robinhood, it went through right away. So I just wanted to mention that. Now, so there's 4 boxes here because there's 4 different scenarios. There on the top, there's buy and sell. On the side here, there's put and call. So you can either be the buyer, you could buy a put, you can buy a call, or you can be the seller. You can sell a put and sell a call. Which one would you like to be? Who the hell knows? I'll explain both, and then I'll get into what I do at the end. So now, as the buyer, keep in mind, you're paying the premium. So you're paying a premium for a what if. What if this happens? As the seller, you're getting the premium. And, you're getting the premium because you're putting up money. Either new money or you own the shares. So let's just look at the first box. Buying a put. What the hell does that mean, right? What does buying a put mean? So when you buy a put, like I said, you pay the premium. So, and the example I'm using, by the way, I'm using ticker symbol HPQ. That's Hewlett Packard. Irrelevant. I'm not really going to talk about them, but they're the hardware side of it. HPE they also have. That's, think of like the cloud-based software, but HPQ is the example we're using. Their current stock price as of today is $25.17. Market's closed, so it's kind of stuck at that number. Now, these examples, all 4 boxes is if the strike price is $25. Also keep that in mind. So if you wanted to buy a put of HPQ with a strike price of $25, you would pay 30 cents in premium. Also keep in mind, this has an expiration date of January 22nd. This is a 1-week example. In all 4 boxes, this is a 1-week example. So you're buying a put that expires on Friday. Today's Monday. Market's closed, but whatever. So when you buy a put, you pay a premium. You also own shares. So you'll own at least 100 shares of a company. Keep in mind, when we talk about a contract, one contract is 100 shares. So if you own 100 shares of HPQ, you can buy a put with a strike price of $25. Now, why would you do that? Why would I pay 30 cents a share, which is obviously $30, for, a put? What does that mean? You would buy it because you're scared the price might go down. So if you think HPQ might tank by Friday because of earnings, because of inauguration, because of anything, then you could buy a put, because essentially it's like a stop loss or insurance on your holdings. So say you own 100 shares of HPQ at 20 average strike stock price, $26. I don't know, whatever, or no, we'll say $25, and it tanks, and you bought a put. Say it's tanked by Friday, and you bought a put. You can sell those shares now for the strike price. If it does not tank, then nothing happens, and you just lost $30. So that's basically, what happens when you buy a put. You shell out premium, because you think a stock might tank by a certain date. So you're covering your ass, basically. So buying a put, you're paying someone this amount of money if they're willing to buy your shares at this price, no matter what. And you're only going to sell those shares to them if at expiration the stock is less than $25. Because you'll see here, if less than $25, you sell at $25. So the stock could be $20 by Friday, but you as the buyer of the put, you can still sell it at $25. That is the reason you paid the premium. Hopefully that made sense. If it ends Friday and it's above $25, nothing happens. So worst case scenario, you lost out on $30. 30 cents per share times 100 shares, $30. So that's buying a put. Now, buying a call is basically the reverse. So, except obviously, the consistent here is you pay the premium. So if you wanted to buy a call of HPQ with a strike price of $25, same expiration, same everything, that's going to cost you 47 cents in premium or $47 for the 100 shares. Now, so why would you do that? Because you think it's possible that the stock could skyrocket by Friday. Again, why? Something big must be happening, like earnings or something. Maybe they're unveiling a new product, that's the market's gonna like, that you think. But you don't want to buy the shares right now. You just want to buy the option to buy the shares. So you don't want to spend, 100 shares times $25. You don't want to spend $2,500 today. You're willing to spend that amount, on the expiration if the stock skyrockets above $25. So you're paying a premium for the opportunity, basically, for the chance to own the company if it's skyrocketed. So you're very bullish in this example. So again, buying a call, you're bullish. You're paying premium for the opportunity to buy a stock at a certain price. In this example, again, the current price is $25.17. So you're doing a strike price of $25. So if on Friday it's above $25, you as the buyer of the call, you're likely going to buy it. As you can see, less than 25 on Friday, you do nothing. Greater than 25, you would buy it. So that's it. So obviously, if Friday comes and it's less than $25, the stock price, nothing happens. You do nothing. You just lost $47. But again, that's worst case scenario. Now, that explains buying. Now let's talk about selling. So selling a put. Similar here, the buyer's paying out the premium. Who's getting that premium? The seller's getting that premium. Why are they getting that premium? Because they're saying they're willing to buy this stock at the strike price by that date. So they have to post the collateral. That collateral is 25 times 100 shares, 2,500 in collateral. Now, as the seller of the put, you typically want the stock to go up, to stay above the $25. Because in the end, when the option expires, the options contract expires, then nothing happens. Because as you can see, again, if at expiration, if it's greater than 25, nothing happens. And you get your collateral back. And you keep the premium. So what happens if it's less than $25 at expiration? Then you actually don't get your collateral back and you buy that money goes towards this stock. So you buy 100 shares of this stock at $25 regardless of what the current stock price is. So you're buying it from you're buying it from the buyer, if that makes sense. I know it's very confusing. You're buying it from the person who bought the put. So yeah, as when you sell a put, you're kind of thinking, for the most part, the idea is you're bullish on it. So if I would sell a put on, today, $25 on this stock, I'm thinking it's going to stay above 25 by Friday, because I'll collect my premium, I'll get my 2,500 back, and then I can repeat. However, if it comes Friday and it's less than 25, then guess what? I have to buy 100 shares. So what do I do now? I own 100 shares. What do I do with them? I can either sell them right away, or I can look at the fourth box. I could sell a call. So when you sell a call, again, as the seller, you always get the premium. When you sell this call at a strike price of $25, you get 47 cents in premium. Or $47. Now, keep in mind, as I mentioned before, you own the 100 shares. So you own 100 shares of HPQ. So when you're selling calls, typically, you don't want it to get exercised. But, so if it expires less than $25, then nothing happens. If it expires and it's greater than $25, then guess what? You have to sell your shares at $25. Maybe you wanted that, maybe you didn't. But, regardless, that's, worst case. So that's the fourth box. So hopefully I explained that right. Now, I put down here the why. Why would you want to be a buyer? So when you buy a put, you're buying a put for insurance. When you buy a call, you're buying for the opportunity. You're also doing the, when you buy a put, it's kind of like a stop loss. So that's why. Now, why would you sell? For the premium, for one, you're getting paid. And two, again, opportunity. You don't know, what's going to happen. So if you're willing to sell a put at $25, you may love that price. So that's an opportunity for you to get a good price. And again, stop loss when it comes to selling the call. Now, a couple other things I wrote here, and then I'll get into what I do and why. So obviously I went through that's the ticker, that's very important, obviously. The expiration date, some options do weekly, some options do monthly. Typically it depends on volatility. So if a stock is more volatile than others, they're more than likely going to have weekly options available. If they're not, then they'll have monthly. HPQ has weekly, so you can do an options trade, every week on this stock. Now, current price, obviously that matters too. The current stock price, because from there, anywhere you go with the strike price, that will change what you're paying in premium, what you're paying or you're getting in premium. Again, one contract is 100 shares. There's now, the way I spoke about it in this example, it was all cash covered. But you can use margin. I would never recommend using margin for anything, but you can. You can use margin, which is essentially borrowing money from your brokerage. But keep in mind, you have to pay them a percentage. So if you don't have the money, you can do margin. Which, I always say, if you don't have the money, you can't do it. Don't bother. But whatever. If you want to take that risk, the options are there. Levels, like I said, you have to apply to be an option, to use options on the brokerage. But you'd want level 2, which is the basics. The premium, which we kind of spoke of, very important. It's basically the point of the transactions. As the buyer, you want the lowest premium. As the seller, you want the highest premium. And then there's the Greeks, which I'm not going to get into, but there's one that matters, and you should probably look at it, Delta. So there's a whole bunch of others which are kind of useless, but that's a whole nother video in itself. I'm not really going to get into it, but I just wanted to mention it. Now, so what do? Why when I learned options, what did I do and why? So, long story short, I am the seller. I do not buy. Why do I not buy? Because I don't want to pay premium for what if. Why do I sell? For income. It's another way to get income outside of dividends. So if I own 100 shares of a stock and I plan on holding it anyway, why not sell a call at a price that I'm comfortable selling it at? You know, worst comes to worst, I have to sell it and then I could buy it back. But if I want to buy it back, I could sell a put. So if I'm shelling out the money anyway to buy the stock, why not sell a put? I'll get a premium, and then come expiration, I'm buying the stock at the price I wanted. So you can sell puts each and every week, and for the opportunity to buy a stock or not really buy a stock. What I'm doing now though is, I have collateral. Now, what I do is I would sell a put on a stock that I think is gonna either stay level or go up. Because I'd sell the put, the idea is I'm gonna collect the premium, which they pay you that up front, by the way, and then on expiration, I get my collateral back because the stock will not go down. That's my expectation. However, I sell puts on stocks that I do not mind owning. So that's very important, and I would highly recommend you guys do the same. I wouldn't just sell a put because that's all I can afford. I would only sell a put on a stock that you actually would like to own. Now, the way I think about it, I have my dividend stocks. Those are buy and hold forever. And then I have my option stocks. Typically, I want my option stocks to have a dividend too. So, however, they're not long-term holds. They can be, but they're not my favorite. They're like the second tier, we call it. So that being said, if I sell a put of a stock that I actually like and I, come expiration, the stock's under 25, guess what? I have to buy it, and that's fine. I own the stock, and guess what? If they pay a dividend, I'll wait till X dividend date. I'll get the dividend, and then I'll sell a call, and I'll sell the call for the strike price that I paid for the stock, or even higher if that opportunity arises. So, and I've been doing options now for a couple months. I've had a lot of success selling puts, and honestly, I never got called. Guess I'm getting lucky, but in a lot of cases, I sell a put. In this example, at if I did this strike price $25, current stock price is $25.17. Sometimes what happens, the stock keeps going up and up and up. What you could do is you could buy your options contract back early. Because say you collect, 80% of the premium. That contract becomes more valuable. So you can actually just buy it back at a discount and you get your collateral back. So if my premium was $30 that I got, again, up front, because I sold a put, maybe by Wednesday the stock is skyrocketing. Maybe it's at 28 bucks. Maybe I could buy this back at 5 cents per share or $5. So long story short, in the end I'd make $25 in 2 days. So I'd want to do that in that example. Typically I would do that if it's 75% or more of the premium. But if not, I would just let it run out at expiration, and then at closing of that day, you would typically get the collateral back in your account the following day. So that's basically what I'm doing. I'm using that. I have a specific amount of collateral for options trading, and I get premium for selling puts. I use that premium to buy more dividend stocks, and if I get assigned, then I have those shares. I have 100 shares, but right away I plan on selling calls. So it's not like a long-term holding. I'm eventually going to sell it, when the time comes. But I'm going to keep collecting premium in the process. So I hope that was a decent explanation for everyone. If it was, please leave a comment. on this video. Click like, share with your friends, whatever. If it, either way, I'm trying to make, a lot of beginner videos for everyone, and hopefully I can, again, speak the language of the beginner level, not throw out some lingo that is maybe misunderstood. So, like I said, I hope you enjoyed the video. Thanks for watching. If you made it this long, click like, comment, subscribe, the whole nine. And as always, I'm just a broke-ass investor. I'm not a financial advisor. So before you want to dig deep into this, obviously do your own research or consult a financial advisor. It's really up to you. But that's it. That's all I got for today. Thanks for watching. Later.